addressing some hot topics from both a tax and a reimbursement standpoint. My name is Kim Hunredson. I'm being joined today by Brian Birch. I will be addressing the tax hot topics. Brian will address the reimbursement hot topics, and he'll do a further introduction of himself when I turn it over to him. I am a tax partner with iBailey. I specialize in working with healthcare organizations addressing their tax compliance and consulting needs, specifically with respect to all of those potential tax issues that could cause the organization to lose its tax exempt status or result in incurring taxable income. So we are going to start today with some tax hot topics. Most people are aware that last year, about this time, a little bit later in December, we had the Tax Cuts and Jobs Act that was passed. And this was really the most significant piece of tax legislation in the last 30 years. Lots of provisions here impacting individuals, impacting corporations, and specific provisions that impact exempt organizations. So we were not immune from the benefits of the Tax Cuts and Jobs Act. Most of the provisions that came into play with the Act are effective for tax years beginning after December 31st, 2017. So the tax year that we're currently in. So if you're a calendar year taxpayer, these provisions would be applying to the current tax year that we're in. That'll be ending here in the next month. And then if you're a fiscal year taxpayer, you're about partway through the year that these provisions apply to. One of the provisions that we'll be discussing today is with respect to fringe benefits related to parking. That is one of the few provisions that actually will impact people earlier than some of the other provisions because it wasn't for tax years beginning after, it was actually as of January 1st. When a tax act comes into place, it's Congress putting that law into place, and then the IRS and Treasury have to come out with the guidance and the regulations on how that law actually gets implemented. So we have, over the course of the last 12 months, received some guidance from the IRS on how some of these provisions will impact organizations. There are other provisions where we have no guidance, so the rules are in place, but it's up to us as taxpayers and tax practitioners to make a best guess as to what the IRS, how they intend to implement the Act. So as we go through this today, I'm going to share with you the provisions that are most impactful to healthcare organizations and the guidance that we've received to date and where we're still waiting for guidance. So some general tax provisions. So if you are an organization that has unrelated business income, this is where some of these provisions are going to come into play. So if you have activities you're conducting that are unrelated to your exempt purpose, you're conducting them on a regular basis, and you're operating them with a profit motive. So once you have those types of activities, you are subject to tax on the income that's generated from that unrelated activity. And you're subject to tax under the normal corporate tax rules. So therefore, some of these general corporate tax provisions also come into play for exempt organizations. The first one is that the corporate tax rate was changed to a flat 21% for tax years beginning after December 31st. If you're hearing this at all in the news, it's usually touted as this is a great incentive for corporations because it's going to reduce the tax that most corporations pay. For most exempt organizations, this is actually going to be a tax increase. And the reason I say that is for a lot of small organizations that have unrelated business income, they were actually taxed on that income at a 15% rate, and now will be taxed at a 21% rate. And the reason for that is the tax in the past was a graduated rate structure. So the first 50,000 of income was taxed at 15%, and then it went up to 25%. So any taxpayer that has taxable income of less than 93,000 will actually see a tax increase because of this change in tax rates. So, keep that in mind as you're hearing people say this is a good thing. For a lot of us, it's really not going to end up being a good thing. If you are a fiscal year taxpayer, there is an alternative calculation that can be done where you get to do a blended rate for the tax year that ends in 2018. Another change with respect to all corporations is with respect to net operating losses. Net operating losses used to be eligible for a 2-year carryback and then a 20-year carry forward. The tax law eliminated the carryback, but now those losses can be carried forward indefinitely. Another change for the net operating losses for corporations as in general is that those NOLs that are created after 2017 will only be allowed to offset 80% of taxable income. So in the past, you could offset 100% of your taxable income and effectively have zero tax due as long as you had net operating losses in excess of your current year taxable income. Moving forward, even if you have net operating losses, you'll still end up paying tax on 20% of your taxable income. With respect to exempt organizations, there's some changes in how unrelated business income is calculated that also will have an impact on net operating losses that I'll talk about in just a few minutes. There also was a repeal of the corporate AMT. We don't see AMT all too often with our hospital organizations, so this won't have a significant impact. So I just mentioned that there were some specific changes with respect to unrelated business income. As I mentioned before, just to make sure everyone's on the same page with respect to what this unrelated business income is it's an activity that the hospital is operating that's not directly related to patient care or improving the health of the community. So the most obvious example that I'll use, and it's more far-fetched than what we typically see, but if a hospital has space on campus and they decide to open a gas station, the income from that gas station will be treated as unrelated business income because the hospital is in direct competition with other gas stations in the community, and operating a gas station is not furthering the exempt purpose of promotion of health. So the income on that activity would be subject to tax. In the healthcare arena, the things that we see are more non-patient related. Maybe you have a reference lab where you're providing services to other hospitals, but not to your patients. You're selling diagnostic medical equipment to non-patients. So those are more common examples that we would see. The new rules effectively say that if an organization has more than one unrelated activity, they have to effectively silo those into different trade or businesses. And to the extent that you have a loss on one activity, you cannot use that loss to offset income from another activity. So it effectively requires us to first determine what is a trade or business, and then second, calculate income and loss separately and pay tax on any of those activities that are generating income. And this is very different than what the rules would have said in the past. So in the past, you would take all of your activities, you'd put them together, you'd take the total income less the total expenses to come up with a total net income or loss, and you would pay tax if there was any gain at the end of doing that calculation. So why the change? The biggest reason or the context for this is that there's about 400,000 exempt organizations that file a 990 every year. About 45,000 of those organizations file an I-90T. So those are organizations that identify that they have unrelated business income. More than 50% of those returns that are filed did not actually end up paying any tax because they had losses that were being generated. So the IRS's thought here is that organizations were either treating things as unrelated that maybe weren't, just so that they could take advantage of those losses, or that they're conducting activities that really maybe don't meet the definition, because if you're conducting it with a loss, one could argue there really isn't a profit motive, or you're not truly operating a trade or business. This rule, so the law went into place, we're still getting information on how it's going to be implemented. It puts exempt organizations at a disadvantage to other corporations, because if I was a taxable corporation and I had multiple divisions, I would be able to lump all those divisions together, just like we used to be able to do. So there has been pushback and calls for repeal of this rule. It's hard to say if anything's going to happen with that, but it is something that continues to be talked about in legislation. So we did receive guidance from the IRS on ways that we should start to interpret the new legislation, because there were a lot of questions with respect to how do you define a trade or business. If I have investments and I'm investing in partnerships, can I lump all of those together and call investing a trade or business, or do I have to actually look into the partnership and determine what activity is being generated in the partnership? So the guidance that came out, and again, this is a best practice. This is providing us with what the IRS would consider a good faith effort in complying with the rules and regulations, or with the rules, but this guidance will have to be turned into actual regulations before it becomes something that the IRS can use in enforcement. So the first thing they said is that you have to use a good faith effort in determining separate trades or businesses. And one good faith effort would be to use the NIACS code, which are the North American Industry Classification System codes. So an example of this would be that every trade or business has a NIAC code assigned to it. There's different levels of code. So a 6-digit NIACS code gets very discrete in its definition. So an example I'll give is a 3-digit NIAC code would be advertising. So a broad classification of advertising. A 6-digit code would go to broadcast advertising versus newspaper advertising versus media advertising. So if the IRS adopts a 6-digit code, an organization that had 3 types of advertising would have to look at each type separately in determining their income or loss. Whereas if they went to a 3-digit code, you would look at all of your advertising and lump it together. So at this point, they're saying you have to use that 6-digit. Many of the comments that have come back to the IRS would be to say, if we're using this, it should be the 3-digit. Expenses need to have a proximate and primary relationship to the activity, so you can offset your income with expenses, but they need to be related to the activity. If you have partnership investments, the guidance came out with some information with respect to how those partnership investments would be viewed, and they came up with a term of a qualifying partnership interest. A qualifying partnership interest effectively says if the organization is invested in a passive investment and they don't actually control the partnership, Then you can lump all of the activities within the partnership that are generating unrelated business income together, and you don't have to look at them separately. And you can lump all of your qualifying partnership interests together. This becomes where we see this most often in the healthcare arena would be with larger health systems that might have pools of investments where they're investing in more complex alternative investments. Many times those alternative investments are actually invested in different types of partnerships, and those partnerships are generating unrelated business income. So this would allow, in that case, it would allow, as long as the hospital's investment is less than 20%, it would allow all of those to be lumped together as one trade or business silo as investing. The comments that have come back to the IRS on this would say, in most other situations, control is defined as 50%. So we'd like to see the same type of rule, but let's move it up to a 50% ownership. The next piece within this guidance was indicating that if amounts needed to be included in unrelated business income due to the fringe benefit rules, which I'm going to touch on next, that is not a separate trade or business, and the income from that can be offset by net operating losses from any of the activities that the organization is conducting that are generating losses, which would mean that net operating losses can actually offset that income, which will be a positive thing. And then I mentioned earlier that the NOL rules changed. And with respect to exempt organizations, there's an additional piece to the NOLs, and that is if an activity, one of those separate trade or businesses, generates a loss, that loss can only be carried forward to offset income from that activity in the future. However, to the extent that you have losses that were generated before 2018, those losses can be used to offset any income that's generated in the future. So in doing this ordering, you first would come up with your separate income or loss from each activity. To the extent that you have income, you would use any losses from that same activity that were generated post 2018. And then you would net all of your remaining income together, and to the extent that you had losses that were generated before 2018, you can use those losses to offset that income. So organizations that have net operating losses will continue to be able to use those until they're expired. So some key considerations: if you are an organization that has unrelated business income, some of the things to take away from this and think about is that you will need to review your methods for tracking and allocating expenses. What we found in the past is that maybe we weren't real specific on those expenses because we would just allocate a total general or administrative expenses to our pot of unrelated business income, and now it's going to be more important that you know how to allocate that to each specific trade or business. If you have a situation where, and I don't think this will be likely for most organizations, but if you had a situation where doing this separate computation would significantly increase your unrelated business income, you actually could consider moving all of those activities into a taxable subsidiary. And within a taxable subsidiary, you would be able to net the gains and losses together. Because I mentioned earlier, regular corporations aren't subject to these same rules. You'll need to have a reasonable method as to how you're coming up with how you're defining your separate activities, whether you're using the NIAX method or if you're using some other method. You'll have to have good ways to track your pre-2018 NOLs versus your post-2017 NOLs, and then making sure that we're calculating estimated payments for 2018 using those new corporate rates. Again, whether it's increasing your liability or decreasing the liability. Fringe benefits. So this is probably one of the areas that I think in general, Congress probably thought was just a sleeper issue and it really wasn't going to have any significant impact on exempt organizations. And it has probably become the issue that is getting the most scrutiny, the most discussion. The rules just don't seem to make sense. And I think that there is a good possibility that these rules will go away. There have been 3 or 4 different legislative proposals within the last couple of months that have included provisions to repeal this 512A7, so this new code that came into place. But at this point, you know, it is good to know that you do have to follow this at this point. So let's talk about what I mean by fringe benefits. The Tax Cuts and Jobs Act for regular corporations is disallowing a deduction for any tax-free fringe benefits that are provided to an employee with respect to qualified transportation and qualified parking facilities. So if you were a taxable corporation and you provide parking benefits to your employees and you don't treat it as taxable compensation, a taxable corporation is no longer able to take a deduction on their tax return for that benefit provided. And when I say that, in most situations, we would expect that that benefit would be a situation like, I work in downtown Minneapolis, and if it costs $200 for me to park a month, and my employer pays that $200 on my behalf, that doesn't become taxable income to me. There's a provision that says as long as it's under $260 a month, it's a tax-free benefit. But now my employer wouldn't be able to take a deduction on their tax return for that $200 per month. Well, Congress decided that it would be an unfair advantage for exempt organizations to be able to provide those same benefits and not have a tax impact to it. So since we don't care if we get a tax deduction, they decided that instead that benefit would be picked up as taxable income by an exempt organization. So it would be treated as unrelated business income. That's what the law says, is that to the extent that a deduction is not allowed for a for-profit corporation and it's incurred by an exempt organization for qualified parking, qualified transportation, it needed to be picked up as unrelated business income. Lots of open questions with respect to that. And when these rules first came out, you know, everyone thought, well, it makes sense if the employer is specifically paying for someone's parking, like my example. But people started questioning, well, what about, does that mean if we provide a flat parking lot outside of our hospital and our employees park there for free, they can't possibly be expecting that that is a benefit that's being provided to our employees and that we have to turn around and pick that up as unrelated business income. And for the last 11 months, I would say most practitioners said, no, we don't think that's what they're talking about. We think that the argument there would be, there's really no value being provided to your employee because you don't charge anyone to park in your parking lot, nor does anyone in your community charge anyone to park in a parking lot. So therefore, we think that a reasonable interpretation would be to say, since there's no value provided, there's really no benefit. Well, that was the thinking for the last 11 months. And on Monday, we received guidance from the IRS with respect to this issue. And the guidance that came out effectively said you cannot rely on a view of value as a reasonable method in determining this. So they said in a situation such as my example, that a rural hospital has a flat parking lot and allows its employees to park there in addition to its patients and visitors, there is likely or potentially a possibility that that will need to be picked up as that the expenses you incur will need to be picked up as unrelated business income. So before, I'm sure if I could see you all, you would be looking at me going, you've got to be kidding. So let's talk through kind of how they put in place what is reasonable here, knowing too that this is a notice that's guidance. It is not regulation at this point. The IRS has asked for comments back from the exempt community on, does this make sense? This guidance actually came out and it addresses both taxable corporations and exempt organizations. So this issue I don't think was even on the radar of most corporations. And whenever I would bring it up to my fellow tax partners, they'd look at me and say, we would never think that that's what they're intending here. The way that this notice is written, it would have the same impact for taxable corporations. So and this is Kim's opinion, but my opinion is things are going to change once the actual regulations come into play. But right now, this is the best information we have with respect to what the IRS is thinking. So let's go through it. They say that if you are an employer and you pay a third party for your employee to park, the total cost that you incur on an annual basis is picked up as unrelated business income. So in my example, the $200 per month for 12 months would, for me, would be picked up as unrelated business income by my employer if my employer was an exempt organization. If the amount that they paid, let's say the amount they paid for me was $300 a month, then the amount that's over this $260 limit would actually, $40 would be taxable to me. The $260 a month would be taxable to the corporation. So that's the situation of an employer pays a third party. In a situation where the employer owns or leases a facility from someone else that they use for parking for patients and visitors, students, and employees, or just the general public, you have to identify what your total parking expenses are. And the types of expenses that they say are the things to consider are listed here. So repairs, maintenance, utilities, insurance, taxes, snow removal, if you have parking attendants, security. So you have to come up with what are your total expenses. And that is the amount that's subject to taxation. However, the amount that's actually going to be subject is going to be determined based on employee usage. And they do provide a safe harbor that you can use in doing this calculation. If you follow the safe harbor, you will be found to be using a reasonable method. So the safe harbor is a 4-step approach. The first step would say, if you have any spots that are specifically reserved for employees, that percentage, the number of spots as a percentage of your total spots times your expenses will automatically be treated as UBI. So they did have a provision in here that says if you have that, and by March 31st of 2019, you go and remove all of the signs so that you no longer have reserved employee parking, then they will treat that as if you never had reserved parking. So it'll go retroactive back to January 1st. So that's the first step, is do you have reserved employee spots? Then you look at the remaining spots and you figure out what the primary use is. And if you can say that more than 50% of the spots that you have are for the general public use, then you can stop this analysis and none of your remaining expenses are UBI. When they define general public, they say students, patients, visitors, customers, vendors, and you have to measure that during your normal business hours. So you don't have to go out and actually count every day, but you do a general assessment during your normal business hours, and any spots that are typically vacant would be considered general public. So if you can do that and more than 50% are being used by the public, then you don't have to worry about doing any further calculation. So their feeling is that this would eliminate most organizations from having to be subject to this tax. I don't know that that's necessarily true for a lot of organizations, but that's the feeling of the IRS, is this provision will keep most organizations from being subject. The next is, if your primary use is not for the public, then you look for how many spots do you have that are reserved for non-employees. So do you have spots that are reserved for patients or reserved for visitors? And if you do, then you can take that number of spots as a percentage of the total times your expenses, and that's automatically not UBI. And then the rest, you would look at your typical employee use and you come up with some calculation that says, of the remaining spots, we think that 25 or 55% of those remaining spots are being used by our employees, and therefore you take 55 as a percent times your expenses, and that's what you would treat as UBI. So again, this is a safe harbor approach. This is the best approach we have at this point in making this determination. We don't know that this is what will actually end up in the regulations if the regulations get issued. We don't know if this provision will actually remain a piece of law. But at this point, we have to assume it will, and we have to figure out if each organization has something new that they have to treat as unrelated business income. The same day, the IRS issued another notice that says, if you are an organization that would have unrelated business income for the first time because of this new fringe benefit rule, and you haven't made any estimated payments for the past year, maybe you're a calendar year taxpayer and you didn't even know these rules were in place, or you were thinking you could look at the value. If you haven't filed a 990T in the past, and if you timely file and pay your tax related to the fringe benefit UBI, then the penalties for not making estimated payments will not be put in place. So what would be my recommendation at this point with respect to fringe benefit? One, I think continue to monitor challenges to the legislation, continue to monitor updates that are coming out to see if there's anything that's changing with respect to this. If you are interested, you can submit comments to the IRS with respect to what you think of these rules. That comment period is open through February 22nd. So comments are definitely desired by the IRS. They want to hear what people think. But other than that, I would say, if you think about your total parking expenses, if you think that those would be less than $1,000 and you don't have any other UBI, there really is no additional effort that's going to be needed. And the reason for that is there's a specific exclusion on unrelated business income of $1,000. So as long as you don't have more than $1,000 in expenses, you can probably feel comfortable that you wouldn't have to file a 990T and pay tax. If you're over that $1,000 and you have reserved employee parking spots, I would consider eliminating those by March 31st of 19. Remove the signs, remove the barriers, so that that doesn't make it automatically a portion of your expenses UBI. Then think about whether that primary use test could be met. So could you reasonably say that more than 50% of your parking spaces are being used by the general public? If you can't get to the primary use test, then you're going to need to do something to properly report and pay that tax. So I would encourage you to, think about this, how it would impact your organization. Think through these steps. Reach out to whoever it is that you use to help you with your tax return if you use a provider, and have a discussion about what you need to do with respect to this. I do anticipate, we're going to see some additional guidance here in the next couple of months. Another provision, we'll get off of unrelated business income. Another new provision was an excise tax on executive compensation. And I would say for most organizations, this probably is not going to become an issue because this excise tax applies for payments in excess of $1 million to any one employee. So I know when I usually talk about this, people will say, I wish that I had this issue. So know that this is out there. The one thing that could catch people unaware, even if you don't meet that $1 million of compensation, is there's also a provision for excess parachute payments made to a covered employee. And an excess parachute payment is a payment when someone leaves the organization that's more than 3 times their normal compensation. And that would include if they had a deferred compensation plan, that gets pulled into this calculation. So that's where I think some organizations may be caught unaware. We have not seen any guidance with respect to this. There's a lot of pieces of this excise tax that are unclear in the definitions. So more will be coming on the executive comp excise tax. So that's, I'm going to close up the Tax Act piece of this and move on a little bit to the 501R compliance. I know everyone should be aware of 501R compliance. Just a quick overview, just to make sure everyone knows what I'm talking about. If you remember, back in 2010, these new rules came into place saying that hospitals had to do certain things in order to maintain their tax exempt status. The first was that they had to do a community health needs assessment and an implementation strategy, and they needed to do that every 3 years. The report that's issued on the community health needs assessment and the implementation strategy have to be available on your website and at your hospital facility. And you need to, in your tax return, report annually on what you've done to make efforts to reduce those needs. I would just, as a reminder to organizations, make sure you're aware of when your last community health needs assessment was done. Most organizations had to have that done for the first time in 2013. So many organizations did one in 2013, then again in 2016, and likely will have another one due here in 2019. So make sure you're on top of that. There is a $50,000 penalty if you fail to do your assessment on a regular basis once every 3 years. So, and that assessment we are seeing the IRS implement. So make sure you know where you're at in that cycle. The other piece is establishing written financial assistance and emergency care policies. The piece I would remind you on here is that a part of your financial assistance policy is that you have to indicate which physicians who provide services at your clinic, at your hospital, are covered or not covered under your financial assistance policy. And that is supposed to be updated every 4 months or every 3 months, so quarterly. So making sure that someone is responsible for keeping that updated. Limiting the charges amounts charged for emergency or medically necessary care for individuals that are eligible for financial assistance. This is that amount generally billed. And this calculation needs to be updated on an annual basis. And you need to make sure that your financial assistance policy indicates how it's being calculated and what that amount is. And then making reasonable efforts to determine if someone's eligible for financial assistance before you start debt collection. So these rules are still in place. Most organizations, or you should already have them in place. You shouldn't have to be updating policies or doing a whole lot with them on an ongoing basis, other than monitoring to make sure that they're still being followed. So with respect to that, we continue to see IRS compliance checks. Some of you may have been lucky enough to get a letter from the IRS that they were looking at your organization. So Congress requires IRS to review every hospital's compliance with these rules every 3 years. So the IRS has a process in which they are looking at every hospital once every 3 years. They are using these as compliance checks, so it's not necessarily an audit, but instead they will be looking at compliance with the rules. You may not even know that they've looked at you. So most of these start as a desk audit, which means someone is assigned your hospital. They will likely go out and look at your website to make sure all of the things that are supposed to be on your website are out there, and that they don't see anything that would indicate you're not following the 501R rules. If they find something that looks to be out of place, that compliance check, then it'll then go to a compliance check where you typically will get a letter from them indicating that they've noticed something out of place and ask you to correct it. Depending on what else comes out of that, it could actually turn into a field audit where they may actually come out in the field and they can open up more than just 501R compliance, and they can make this into a full audit where they will look at other issues. So what we've typically seen related to the compliance checks is the first round, probably 3 years ago, they were looking for the community health needs assessment, looking to make sure those were on the website. The second round, they started looking for policies on the website, and they would indicate if they didn't find the policies. Now they've shifted into actually reading the policies, pointing out deficiencies in the policies. I would anticipate that the next round will be, how are you actually implementing the policies, and give examples. We have seen where they've asked for hospitals to provide information on certain patients and what their billing looked like, so that they can see how the actual language and requirements are being implemented. So making sure that you are aware that your organization has these policies in place and continues to monitor them is very important. And then lastly, just a quick IRS update. So the IRS has regular conference calls with individuals like me that work in this area, just to provide updates on what's happening with them, helps us to understand what we can expect to see. So the IRS has been allocated more funds to hire approximately 400 more agents in the exempt organization area. Because of that, we anticipate that we will see continued examinations and probably more examinations. Many of those agents will actually be going to the determinations area, which is if organizations are applying for tax exempt status. That process has been really slowed down and delayed. It's an average processing time of 160 days. So they're looking to reduce that. Another thing the IRS has done and will continue to do with these agents is they've really updated their website specifically for exempt organizations. So I encourage you, if you're ever bored and want to look at tax things, they've got issue snapshots, podcasts, webinars with respect to different aspects of tax that impact hospitals and exempt organizations. There's also an updated search engine on the website where you can look up exempt organizations. Just a few things here on compliance contacts. of interest. They did 8,000 compliance contacts. That includes these compliance reviews and examinations. With 501R, they did 475 examinations. So that's not just the compliance checks, that's actual examinations. 14% of those resulted in a tax for failure to complete the community health needs assessment. So it is something they are definitely looking at. And then the areas that they're going to be looking at in 2019, social clubs, charitable trust, for-profit to exempt conversions. We've seen some of those happening. And then they continue to focus on employment tax. So making sure that you're paying your employment tax, you are doing backup withholdings where needed, and then worker classification. So with that, I will turn it over to Brian and let him talk through some reimbursement hot topics.
Thank you, Kim. This is Brian Birch, and I'm a principal in our healthcare consulting practice. I've been with the firm a little over 21 years now, spending a lot of my time in the reimbursement sector, Medicare, Medicaid, things like that, and probably dealt with a fair number of you on the webinar today over the course of the years. Just have a few items today I wanted to touch on with you on in regards to the cost report reimbursement. Some other of the other issues is things that you might be thinking of in regards to building or things like that, but kind of some questions that I've been getting lately that I want you to think about if you are reconsidering maybe some different building locations and things like that as a critical access hospital. So with that, we'll move forward. Revenue code mapping. So the first issue here is really on the Medicare cost report. You know, Medicare reimbursement, primary philosophy here is matching of revenue and expenses in each of the separate cost centers on the Medicare cost report. So again, we need lab expenses on the worksheet A of the Medicare cost report. We obviously need the lab revenues in that same cost center on worksheet C so that we determine a proper cost to charge ratio for each department. That's the fundamental rationale in establishing the proper reimbursement. Well, when we get that proper cost to charge ratio on the cost report, then we have to map our Medicare revenues from the PSNR for those ancillary cost centers, OR, lab, radiology, ER, therapies, things like that. So map our Medicare revenue to the cost to charge ratios for each cost center. And then Medicare computes the proper Medicare cost, or the cost report computes that proper Medicare cost. The issue is with it, when we talk about revenue code mapping, then is making sure that we're getting that Medicare PSNR and the revenue codes there mapped to the proper cost center on the cost report. And so improperly putting a revenue code to the wrong cost center leads to improper reimbursement, and a lot of times we're missing out on reimbursement when that revenue code is going to the wrong department, okay? And so what we need to understand is for your cost report preparer, or if you're doing your cost report internally, is that in order to fully understand where those Medicare revenues are assigned, you typically need a revenue and usage report, all right? And so with the revenue codes indicating what departments were all of our revenue codes billed out of. And that usage report really will then include revenue by department in total and by financial class, because what we're really after here is Medicare revenue and the revenue codes that were billed out of each department. And so again, this is going to match up with your general ledger so that we can, cost report preparer can be certain that we've got the right revenue coming out of each department. And then we'll use that usage report to then determine which revenue codes to assign to which cost centers. Now, you may be utilizing multiple revenue codes and billing multiple revenue codes out of 2 or more cost centers. And when that is occurring, then that's specifically why we need that usage report, because then Medicare requires you to split the Medicare revenue in between 2 different departments based on how much Medicare revenue was utilized out of that each department. And I'll show you an example in that a little bit. So again, really a usage report that has Medicare revenue on it, not in total, revenue, but really Medicare revenue, because if we use total revenue to split our Medicare revenue codes, that can distort how much revenue is going to each department. And I've seen some really interesting things when that happens. Just to give you an example, all of a sudden the labor and delivery department ends up with quite a bit of Medicare revenue going to it, when obviously we all know that it shouldn't. So that revenue and usage report, I really want to emphasize this and ensuring that we're getting proper reimbursement, that we always have that as a critical access hospital, always have that provided to your cost report preparer and the preparation of the cost report. And as we see hospitals convert EHR systems, not always are those new EHR systems able to get a good usage report out of the system. The interesting piece is the data is all there, and so I know it's available to obtain. The question is just how we get that data, and I cannot stress to you enough and how imperative it is to get a good revenue and usage report out of your systems. So I really wanted to put this up here for you and show, what would we as cost report preparers love to see on that usage report. So the items on here is what I have. So it's number one is the departmental revenue by charge code that ties to your general ledger for that department. Okay, so all the lab revenue ties in total, so I can look at that usage report. It lists all your charge codes that are billed out of lab. It gives me total revenue for the lab department for the entire year, and I can look at that total, and it ties right back to your general ledger for the lab department. And then, so it's going to have it by procedure number, charge code. It's going to have the procedure description in it, number 3. Number 4, it's also going to contain on it the revenue code that was billed for that particular procedure number, and emphasis on this that revenue code that's showing up on the usage report contains the code that went out on the claim, not the revenue code that's assigned in the charge master. And what I mean by that is sometimes behind the scenes, the system will change the revenue code that's going out on the claim, but yet the usage report contains the one that's loaded in the actual charge master. For instance, just this year, on our June 30th year-end clients, we're preparing a report for a facility, and we were looking at revenue code 490 on the PSNR, and we were looking at where to map it and stuff, and looking at splits to assign it to various cost centers. And the usage report did not have any 490 revenue code on it at all. Well, what was happening is the 360 revenue code was showing up on the usage report, but behind the scenes, when the claim went, it flipped to 490. And so Medicare was showing they had roughly $40,000 in revenue code 490 charges, but according to the usage report, there was 0. So again, that makes it a little more difficult then to map the revenue when you can't fully understand where the revenue is going to the various departments. Okay, so have it contain the code that went out on the claim. And then also, most importantly, we need the revenue by charge code in order to map it and do splits. So we want the revenue for each charge code by financial class. So I would be able to say, hey, for this procedure in lab, there was $30,000 in total revenue, but 5 of it went to commercial plans, 15,000 of it went to Medicare, and the remaining amount went to the Blues. All right, and so it'll add up to my 30,000. And then again, totals adds up to the total for each revenue code, or for each procedure code. So that's really the most important items that we need there. We have a sample on the next slide here. It can also contain the CPT code and HCPCS code and the individual charge, what you're charging for a price on that particular procedure code. So anything else, is extra, but it's definitely informative and able to have it on there. So here's just a sample of a usage report and what we'd like to see on it. The first department, the table up above, is just med-surg outpatient, so outpatient procedures that are done on the floor. Procedure 1, 2, and 3, the descriptions, the revenue code that was utilized for each one of those procedures, and then how much revenue was generated by financial class, and then in total. So then I'd be able to take this 250,200 in the middle of the page and look at how much revenue, that should tie back to my general ledger then, or at least come close to tying back into Medicare total outpatient revenue for the med-surg department. Similarly, for the emergency room department, then, split out the revenue according down here. And so the same things look familiar from that standpoint, broken out by financial class. So then what do? We take that usage report and the ancillary revenue. So I just gave two here, rev codes from that, revenue code 260 and revenue code 761, and split them out based on the Medicare revenue. And so we'll have to take the Medicare revenue and for 260 and split it 73%. 73.6% would go to outpatient med-surg, and 26.3% would go to the emergency room from the PSNR. Likewise, 761 rev code, we take 81% to outpatient med-surg and 19% to ER. Okay. If we don't have this information, then we're not able to take the Medicare revenue and split it appropriately, and we'd have, really improper Medicare reimbursement, because now you're typically taking those revenue codes and assigning them to just one department if we're not able to split the revenue out. So here's just an example through this. So it's revenue code 490, ambulatory surgical care, typically used in either the operating room or radiology. The revenue from the usage report from total revenue was 75-25. Was the percentage split. However, the Medicare revenue was split 43-57. Okay, so 43% to operating room, 57 to radiology. The interesting piece about this is when you do the first calculation and you use total revenue, the reimbursement ends up coming down to a total of $23,256. All right, but then when you use the Medicare revenue splits, it's $25,900. So you were able to pick up roughly $1,700 here on just this one revenue code by ensuring we have the proper splits from that usage report. Okay, so you can see how this can compound with various usage reports that you have and all of the revenue codes that you utilize in the facility today. So the last items on the revenue code mapping, ensuring that we have it correct. If we have it, we'll definitely use that usage report. When we send the information into the Medicare Administrative Contractor, we want to make sure that we are sending in the revenue code crosswalk and all the according splits to the Medicare Administrative Contractor to make sure that they're utilizing them when they finalize your cost report. So when they're using an updated PSNR and go to finalize your cost report a year, 2 years down the road, they're using the correct information and they're doing it based on what was utilized for that initial submitted cost report. Sometimes they're asked for the MCP file. If you don't know what that is, ask your cost report preparer. That's the file that goes along with the cost report, and that's really the split, determining the splits of the revenue codes. Okay. I would love to say the MACs get this right all the time, but if they don't have this information, they assign the revenue codes as the best way possible that they can, and sometimes that ends up in incorrect assignment of the revenue codes. Always ensure that you're reviewing this and looking at where the revenue codes are being assigned and update to make sure that you're getting the right revenue. I've had a couple lately where they've misassigned where the revenue should go, and it's made a substantial difference in the amount of reimbursement that the facility would have gotten had it not been corrected. Okay. Again, it's just without that information, the MAC may map the revenue codes to different cost centers, resulting in incorrect or lost reimbursement. And the last piece here is just a sample of what that MCP file and the information utilized is just telling Medicare where to assign each revenue code on the cost report. And so we're utilizing they're utilizing this information and we're getting this information from your revenue and usage report. So the next item that we're wanted to visit with you on about is the overhead allocation basis. And I've mentioned this to a number of them, and I think it probably was in a previous webinar, not this fall, but maybe one that I had done last year, not sure when. But it's still a fairly big issue that's out there. In fact, I just wrote a letter, drafted a letter for a client yesterday in regards to this. And what it is MACs are indicating that CMS is providing guidance that you need to have your overhead cost centers must be utilizing the recommended statistical basis, all right? And that if you're not using that recommended statistical basis of allocation, that you have approval to use something different, all right? So what they're saying is here are the cost centers that you would have for overhead cost centers, and then correspondingly, you should be utilizing these statistical basis of allocation. So square feet for building capital costs, equipment capital costs around dollar value, employee benefits is salaries, admin and general is accumulated cost, plant items are square feet, laundry pounds, housekeeping hours of service, and so on, all right? They do indicate that there's some alternative basis that you can be using, all right? And those are found on this page. So if you have maintenance, you can be doing a time study. Housekeeping, you could be utilizing square feet instead of hours of service. Cafeteria, if you're not using meals served, you could use FTEs. And then medical records, instead of hours of service or time study, you could be using gross revenue. However, if you are utilizing these, the MAC is asking, do you have approval, or do you have an approval letter that indicated you could use the alternate basis? Okay, and if you don't have that letter, we'll talk about that in a little bit. So one thing that we do see is that if you're utilizing square feet for the allocation of movable equipment costs today, MAC more than likely, the Medicare Administrative Contractor will more than likely require you to change this to dollar value. Square feet is not an acceptable allocation statistic for equipment costs, so they'll probably recommend that you change that. The issue with this is you're probably using the same statistical allocation basis for the last 20 years, some of them 10 years or more. And so this really came up in that when CMS changed the cost reporting forms for hospitals back in 2010 and said that even though you may have been using a different allocation basis in the previous cost reporting forms, they wanted you to now use the recommended basis going forward. And so essentially requiring you to change to the recommended statistical basis for what's there, unless you had approval to do something else, okay? So what if you are using something different than the recommended basis and you don't have approval, all right? What are your options? Well, in this case of the provider just the other day, they got the management letter. They're using FTEs for the cafeteria. They're saying the MAC said you should be using meals served. And they said if you don't have the approval, you can get approval from us. But if we don't see it, that you have approval on your next cost report, then we will change the basis to the recommended one. So our recommendation is that you do submit a request for change. And why I have change in quotation marks is you're essentially asking for approval to keep doing what you've always done, all right? And as long as the statistic that you are using is one of the approved alternate bases, you shouldn't have an issue, okay? That the MACs are kind of rubber stamping them. Again, this is not just a particular MAC. This is, I've seen it in 3 different MACs right now, that this is what they're doing, okay? So essentially you're asking for approval to keep doing what you've always done, and they'll send an approval letter back, and that's now your official approval letter that you can keep using that alternative basis, okay? Again, they do say that you need to make the request in accordance with the applicable regulations, which is 15.1 Provider Reimbursement Manual 15.1.23.13. You must make that request 90 days prior to the end of their period, cost reporting period, and then they have 60 days to make a decision. We did make one outside of that 90 days on a client last year, only because the MAC said, that's fine. You're making essentially a change or approval to continue using what you've always done. So they're not as concerned about the timing as they are about just getting the information in. In addition, the MACs are also reviewing some of the standard cost centers on ancillary and non-reimbursables. The ancillary ones makes a little bit of sense. The non-reimbursable cost centers, that makes absolutely no sense to me. But we did have one particular MAC question why the facility had chemotherapy and sleep study and diabetic ed and outpatient services as separate cost centers, and not these didn't conform to their recommended standard ancillary cost centers on there. And it involved your cost report preparer in this, but the response on a lot of them is these are separate cost centers, and if they have separate staff and wages and supplies and benefits and things like that, then to me they're legitimate cost centers. It just doesn't fit one of the standard cost centers that they include in the ancillary cost centers on the cost report. Why they asked about the non-reimbursables, I have no idea, but in this particular client, they asked why these were included and listed separately too, which again, I think maybe we had a young auditor, but those are the kinds of questions that are coming up in regarding to using standard cost centers. Okay. So some items on clinics that I wanted to visit with you about. So the first one is provider-based clinics. Just an opportunity that we see on a provider-based clinic, not an RHC, but in regards to the compensation that you may be paying if you employ the physicians or the advanced practice providers, most of the compensation is not an allowable expense in a provider-based clinic because the compensation is paid through the Medicare physician fee schedule, and so that compensation is eliminated on worksheet A82. All right, so you bill a professional and the technical fee to Medicare, and so that the compensation portion is paid through the fee schedule. Some opportunities here that we see is that you may be paying these practitioners, that provide services in the clinic. You may also be paying them in the emergency room also to do coverage, or they may be doing some administrative duties or acting as your medical director. If they are doing ER room call coverage, let's just take a look at that occasionally. Keep this in the back of your mind that when was the last time that compensation was updated, because that is an allowable expense. So when you're looking at the portion of their total compensation, if we keep giving them increases on the clinic side, that's non-allowable, and Medicare isn't recognizing any of that cost. But the emergency room call coverage component is an allowable portion to the extent that they're available and on call. And so that, just look at that portion too, should that be increased? And I just have dealt with a couple providers over the last year that portion of the compensation hasn't been increased probably about 4 to 5 years for their providers that also do services in the clinic. So look at that as an opportunity, and then also any administrative duties that they're doing and carving out any compensation via time study that they're performing administrative duties or acting as the medical director. So then you can get these costs as allowable costs on the cost report. Rural health clinics, I didn't want to have you feel left out, but probably the biggest thing that I'm seeing in affecting rural health clinics right now is still being impacted by the productivity standards, okay, which then reduces your Medicare reimbursement. Again, the productivity standards for a physician, it's 4,200 visits per FTE. Advanced practice providers, it's 2,100 visits per FTE. Again, this equates for a physician of a little over 16 visits per day and a little over 8 visits per day for an APP, all right? The biggest question that biggest piece of advice and discussion that I have with hospitals that have provider-based rural health clinics is the definition of an FTE, okay? And the FTE on the RHC cost report is for providers is the time spent seeing patients or scheduled to see patients and does not include administrative time. That's right out of the benefit policy manual. All right, again, time spent seeing patients or scheduled to see patients. So on the RHC productivity standard, if you're not meeting the productivity standards, what can we do? So there's a number of options here, really looking at a deep dive into the FTE and what's included in your PTO or what's included in the FTE. Are we including PTO, extended sick leave, non-productive time? Those should be not included. Don't include any administrative time as a medical record or a medical director either. So again, those costs or that time should be out. The one thing here in red that I often find is probably the most benefit to the facilities, if I go back and as in the slide before, it's the time spent seeing patients or scheduled to see patients. If we actually track the hours and the days the practitioner is actually seeing patients or scheduled to see patients in the clinic. Now, it's not just clinic, but swing bed and nursing home that you may be billing as RHC too. If we actually track the hours, that a lot of times it's significantly less than what we're seeing is being provided to us by saying the practitioner is 2,080 hours and then backing out the non-productive time. All right. So I encourage each of you, if you are being impacted by the productivity standards in your rural health clinic, to really look at the hours that you're providing to the cost report preparer and how we're getting those hours and tracking those hours. Really, I've seen a number of providers switch to where they're tracking that now on a weekly and monthly basis for each one of their practitioners and having it accumulate during the year rather than waiting to the end of the year and then having to go back and figure something out. Another option is to request an exception to the productivity standard. Sometimes that's difficult to do, and I always say at first make sure that we're tracking the FTE appropriately. Okay. Some reason, Amy, I can't advance the slide. There we go. Hospital outpatient departments. So hospital outpatient departments, again, is any service being billed as hospital outpatient to Medicare or provider-based as a critical access hospital. So this could be a provider-based clinic, a physical therapy department, radiology, any others, all right? So all of your ancillary departments are considered hospital departments, and if there's outpatient services being rendered, they're a hospital outpatient department or a provider-based department. So what's the issue here? I've had the question quite a few times lately in the last couple of months about establishing off-campus hospital outpatient departments of a CAH, all right? And so it'd be I'm purchasing a clinic in another community, or I want to establish physical therapy services in another community, all right? Well, I just want you to be aware of and cautious if you're thinking about that, the off-campus and co-location requirements for CAHs. So this is 485.610 conditions of participation. Really, it's E2 here that in the second paragraph, and I know it may be hard to read, but it says if a CAH or a necessary provider CAH, meaning you were grandfathered in and you were got under the necessary provider designation for your CAH prior to 1/1 of 2006, that if you establish an off-campus provider-based location on or after January 1st of 2008, essentially that location needs to meet the mileage requirements, which means that it needs to be 35 miles away from another hospital. Okay, so when you're thinking about establishing new hospital outpatient departments, it could be in another community, or it could be in your own community where your CAH is today, but that location is off campus, which is off campus is more than 250 yards away from the hospital. If you're doing that, you need to be really careful on that, because if that location isn't 35 miles away from another hospital, it's not going to meet this requirement. And if you don't, you could potentially lose your CAH status and your CAH provider agreement unless you terminate that off-campus arrangement. Okay, so again, be aware of this as you're doing those things. Essentially, that's what this slide says is you could jeopardize the CH status of your facility. Two other items that I just wanted to mention that in relation to this, for a hospital outpatient department, if you have already an off-campus one that you're billing provider-based for, so you're billing provider-based for a clinic that is off-campus, and because it was established prior to January 1st of 2008, if you're going to relocate that campus or relocate that clinic, you're going to jeopardize that payment status because you're not, and it's within 35 miles of another hospital, you're going to probably lose that provider-based status for that location. All right. So, for instance, if I had a clinic in community X that was 10 miles away from me, the clinics there, I'm billing provider-based for it, have since 2003. But the building's getting older, and I'm going to build a new building at a new physical address in that same community. But so I'm going to relocate that clinic. You're more than likely going to lose that provider-based status because if it's not more than 35 miles away from another hospital, it won't meet that requirement of E2 in 485-610. Okay. It does exclude RHCs. So if you go back to that previous slide for you, it does exclude an RHC. The one thing that I would say about relocating an RHC, if you have RHCs instead of a provider-based clinic, if you relocate an RHC, you can do that, but it still needs to meet the rural designation, and it needs to meet the shortage designation if you're changing physical addresses for an RHC too. So just some items to protect your reimbursement statuses that you have today if you're thinking about relocating any of those departments, clinics, etc. That's all I had on reimbursement today. Thank you. Before we move into questions for Kim and I did want to do a plug for our Critical Access Hospital Conference in 2019. It's in San Antonio, Texas, April 4th and 5th. Be a nice, sunny, warm location. Again, April 4th and 5th in 2019 in San Antonio, and more information will be coming out on that fairly soon. And then one other item for those entities that have rural health clinics, we will be in January sending out information on a rural health clinic webinar series that'll be held February 15th, the 22nd, and March 1st. So it'll be a series of 3 webinars for those of you that have rural health clinics. So we'll be looking for that information coming to you soon. With that, we'll open it up for questions.
Awesome. We did have quite a few come in. Okay, so the first one is, would retail pharmacies and assisted living care be considered unrelated business? Is this an area where the IRS Notice 2018-67 would be helpful to determine this?
So that I'll jump in on that. So the notice itself will not provide any guidance with respect to the determination of unrelated business income. It instead really addresses, once you've realized that you have unrelated business income, how you treat it. With respect to the specific question on are retail pharmacies and assisted living unrelated business income, the answer is they can be. Typically, with retail pharmacies, yes, to the extent that you're selling things to non-patients where you don't have a patient relationship. Assisted living is typically going to be a related activity unless it's structured in a non-charitable manner.
Okay. Employee parking. Is depreciation expense counted as expense for UBI?
No, great question. No, they specifically carve depreciation out of the expenses that are considered parking expenses.
We are a county hospital. How much of this is likely to apply to us?
So assuming that the question is with respect to the unrelated business income, county hospitals will be subject to the fringe benefit rules. We haven't seen that there is a specific carve out. So from what we can interpret, it does appear that governmental entities are subject to the fringe benefit rules. that there could be something more coming out on that. County hospitals are subject to the 501R rules only if you have dual status. So if you are also qualified as a 501c3 entity, and county hospitals would be subject to the UBI provisions as a whole too.
Okay, looks like down a little bit later, he did mention the question was related to taxation. So maybe you already answered that. Okay, employee parking. If we have whole lots dedicated to employees, the whole cost is UBI?
Correct. Yeah. So what they say is that you would look, so when you say whole lots, if you had, let's say, 3 parking lots and one of them is dedicated to employees and the other 2 are dedicated to your patients and visitors, and they're all within a close geographic proximity, you would actually look at all 3 of those lots together in doing the calculation. If they're in different geographic proximities, or if your only parking lot is for employees, then I would agree that 100% of your expenses would be UBI.
Okay. Was that for the UBI parking, was it effective 9/30 of this year or next year?
So the parking fringe benefit became effective for expenses incurred starting January 1st of 2018. So even fiscal year taxpayers will have, so if you're a 6/30 year end, you'll have 6 months worth of expenses that will be treated as UBI for your tax year ended 6/30 of 18.
Okay. Do any of the tax updates or 501R apply to county government owned hospitals?
So I think that should have been answered earlier.
Okay. What are the requirements for the frequency and duration of time studies?
Well, I'm guessing that's me and not you, Kim. So on the time studies, it does vary. And so in regards to the time studies that I mentioned in for physicians and advanced practice providers, essentially, if you have a combination of physicians and advanced practice providers, mid-levels in your facility, I strongly recommend doing 1 week a month, rotating week time studies. So first week of January, second week of February, third week of March, etc. Some MACs have issued separate time studies and requirements in regards to ER coverage for physicians, such as 2 2-week time studies every quarter, or 2 2-week time studies throughout the year. Again, but they've said that's only for physicians, that mid-levels need to still be 1 week a month, rotating weeks. So my statement is always, please, if you have a combination of practitioners, please do the 1 week rotating weeks time study for all practitioners. It's easier to remember to do that than it is to try to remember, well, the one subgroup of practitioners is these 2 week periods, but another subset is 1 week every month, etc. So that would be my response there.
Okay, last question that has come in. What is the distance requirement to construct a replacement hospital building for the existing one so as to maintain our cost status?
Yeah, so that one, I'm going to start out by saying I'd encourage you to reach out to me directly so we can have a further conversation on that. There really isn't a distance requirement if you're replacing the community and establishing that in your same community, but there is some tests that you have to meet if you're building a replacement critical access hospital. And what Medicare refers to the test as is the 75% rule tests. And so are you going to service 75% of the same patients that you were before the relocation, 75% of the same staff and practitioners remain on your staff after the relocation, and that you're providing 75% of the same services after the relocation as you did prior to relocating. So those are some of the things. There is advanced notice to CMS, the regional office, if you're doing a relocation and things like that, but would really like to talk that through and make sure you have a good understanding of all those issues before beginning construction. So
cool. Well, that is all the questions that have come through. So if you guys have any more questions for our presenters, please feel free to reach out to them directly. This session was recorded and it will be published and sent out to everybody within 10 to 14 days after this session. So thank you guys. Do you have anything else to add, or are we?
That's it for my
thank you, everyone. Yeah, thank you, everyone, for listening, and have a great day.
Awesome. Thank you guys.